Welcome back to Tech Tune Up. Another Friday, another week of what was in the tech sector. I'm Paul Meeks, your host. Our director is Aaron Thomas, and we're all here with Benzinga. Again, I'm a big fan of Benzinga tools. Don't forget their tools and content. Pretty good stuff. So anyway, as you know, in this show, I do highlight some of the news of the prior week, but I don't regurgitate the news. I give you some tells, both micro and macroeconomic, to take forward, make some actionable decisions in your portfolio here today, here now. And I have some good stuff for you this afternoon. But let's get into some of the stocks in the news. First of all, Google, aka Alphabet. This is really interesting to me. I think that over time, Alphabet will be one of the leaders in AI. But their problem is they keep on screwing up. And I think it's more of a public relations snafu than a product snafu, but they keep on announcing products, releasing them, doing demos for the press and the public, and screwing them up. The latest thing is they have a product called Gemini AI, which allows you to create images. The problem is they roll it out with a lot of fanfare, and the images are inaccurate. They're screwed up. They're even racially biased. So this is another thorn in Alphabet. They got to get this right? They're a major company. So that was really bad. Their stock dipped a little bit on this PR nightmare. But I will tell you another thing about the company that actually was positive this week is you may know that the company is in federal court. And they have been accused of anti-competitive behavior. And one of the things they've been accused of anti-competitive behavior is in their search franchise. But they did get a little relief in court this week when it was revealed that Microsoft has been trying to sell its Bing search engine to Apple for years and years for a lot of dough. And Apple's decided not to bite, despite the probably great financial deal that they could get from Microsoft, because the product sucks compared to Google search. And so if it is anti-competitive behavior because you got a superior product, it ain't anti-competitive behavior at all. So kind of a good news, bad news scenario. What I think you should do with this stock, I own it. I'm not buying it here. Specifically, the stock's trading at about $138 a share. I'd like to see it drop down and hold support at its 200-day moving average, which is about $132 plus. So stay tuned. I'll be on top of that story. Next, in the news this week, our buddies at Apple, which is a stock that I've held for years, like every self-respecting tech investor, but it's not on my buy list now, which you'll see in a second. They announced that they're finally, after 9 years, pulling the plug on their Project Titan, which was their entree into the electric vehicle space. I think they're telling you that the EV space is not a good industry. And we've also seen that with Tesla starting to slow down quite a bit. And then I've been following the results of a lot of these emerging EV companies, and they're taking the gas. Most of these companies will go bankrupt. So if Apple, with all of its thousands of people working on the project and the tens of billions of dollars they spent on the project over 9 years, they pull the plug, they're telling you, get out of that space. I am not a big fan of EVs. Over time, it's essentially a computer on a car chassis. What you may want to be interested in is the operating system that propels them. But definitely, you don't want to be in the car making business. Next up on the stock tells list, there was an announcement of mega layoffs at some of these video console hardware vendors. Sony PlayStation dumping a bunch of people. And Microsoft, since it has bought Activision, has fired a ton, and also with their Xbox property. So do not delve in this space through hardware. Hardware, commodity business. They're like potato chips, no value add. What you want to do is play in video gaming. Take-Two Interactive, ticker symbol TTWO. sometime in 25. They haven't gotten more specific, but we have to be prepared to get in 6 to 9 months before the event. They are going to release Grand Theft Auto 6. It will be huge. And so, when do we invest? Probably as we get to the end of the summer, no later than late second half of 24 for the 25 release. So that's how I play it. The rest of the stuff's crap. Next, let's take a look at some of these stocks that were COVID heroes. And unfortunately, now they're goats. Be very wary of buying any of these COVID plays just because they've come down a lot in price from their highs, because unfortunately, they got no growth after the pandemic. And a pretty good example is Zoom, which had a pretty good report this week, not because they really grew much, but Wall Street analysts were expecting worse. And here's Zoom. Here's a company that used to own the world. We're all on Zoom or Skype a couple of times a day, but it's a ubiquitous product, but it's not a profitable product. And now the company is saying they're going to grow about 2 or 3% per year. That is no faster than the rate of the US economy. And that does not get me jazzed at all. Like actually on any run in these stocks, they probably become better shorts. Next, everybody, particularly if you're a Benzinga subscriber, has seen what I call the melt up in Bitcoin and other cryptocurrencies. Now, I'll tell you this. I'm a 6-year-old dude, right? I'm not the guru of crypto, even though I might be the guru of the tech sector. But I will tell you this. I am worried about Bitcoin at this price. Now, there are other sources here at Benzinga that might be better on this, but I will tell you this. If you are going to have a currency over time, and I think if you buy a Bitcoin for an investment and not just a short-term speculative trade, you got to believe that this is going to be a ubiquitous currency. And I don't know if it ever will. And here are the 3 definitions of a currency. Let's see if they meet them. The first is a currency must be a stable unit of account. Now, right now, Bitcoin is on the rise, but it ain't a stable unit of account, right? We go from 15,000 per coin to 69,000 per coin. Ain't stable. And we know it can also be stable in, or not stable, the wrong direction too, as we saw the last year or two. The next is a currency must be a durable store of value. Okay. I actually think that the blockchain technology, which underpins Bitcoin and the other cryptos, actually is quite elegant. And I actually think this definition of money actually meets it. I could say a durable store of value. Yeah, I'll give them that. The third one is it must be a convenient medium of exchange. I don't think anybody, at least not in 2024, thinks that a crypto is a convenient medium of exchange, at least for mainstream purchases and services. And then the last thing, which I think is the most important to think about with crypto, in this country since 1913, monetary policy, or the supply of money, has been controlled by our central bank, the Federal Reserve Board, aka the Fed. They control monetary policy very, very carefully. And unless they have some kind of compromise where they join forces with the cryptocurrencies, it's not going to take off until the Fed says so. And as of now, I think they're going to probably reject that merger. And we'll see. At some point, maybe there is a compromise. And if you have, and only when you have, the US central bank on board with crypto, does it begin to flourish. So we'll see what happens. But that's just my 2 cents as an analyst, but no crypto expert. Next thing I want to share, Alibaba. Alibaba is essentially the Chinese Amazon, the major e-commerce player. Very exciting story years ago. In 2014, they raised $2 billion in an IPO when they listed their shares in the United States. There's only been one IPO bigger, and that was the 2008 IPO of Visa. But I will tell you this. Alibaba has made a $1 billion investment to boost its AI prowess. But here's the problem. I used to be like so juiced about the opportunity for all these Chinese internet companies, particularly since the population of China is 3 or 4x the US. And also at the time, their gross domestic product was growing at a very rapid 5 to 6% per annum easy. But the problem is we see that these governments are these companies are under very tight control by the government. At any time, the feds in China can make these companies go away, no matter how big they are, no matter how fast growing they are. And I just can't invest in that kind of environment. And we've seen that the government has turned against Alibaba and some of the other majors in recent years and just took them to the woodshed. It is just too scary to invest, at least long term, in Chinese tech. Next thing I want to talk about is I was bad mouthing old school media last week's show, and I've been absolutely right, because this week Warner Brothers Discovery pulled the plug on its merger with Paramount, and Paramount is the owner of CBS. I will tell you this. All of these old school media companies, the ones that are dependent on linear TV and hooking up to the cable providers, these are not going to be situations where you go from a company that has no scale, you add another shitty company, and now it's got scale and it's going to be a good company. No, two wrongs do not make a right. And I've told you before, maybe not today, maybe not tomorrow, but if you want to play video streaming, just hold your nose and always buy more Netflix. Do not take any of these kind of turnaround old media companies. Next, the greatest investor of all time, Warren Buffett, the Oracle of Omaha, spoke last weekend when he announced the results of Berkshire Hathaway, which is his investment vehicle. And this is kind of interesting to me as a tech investor, because for the longest time, he said he wouldn't invest in tech because he didn't understand it. As time goes on, several years ago, he made a bad investment in IBM and got in. Stock never worked out, pulled the plug. And then unfortunately, IBM got some AI love in the last year or so, and he missed the run up because he had already sold it. But I will tell you this. One of the reasons I'm a little bit worried about Berkshire Hathaway is its biggest stock holding by far is Apple. And I'm worried because, as you know, I'm not a fan of Apple. The company is not growing. I don't see an immediate growth catalyst, and it's not on my tech buy list. But man, it is very high up on Buffett's buy list. So if you buy Berkshire Hathaway shares, you're essentially making a mega bet on Apple. The next is Salesforce.com. Salesforce.com, ticker CRM, is one of the biggest enterprise software companies, maybe with Oracle and maybe with that portion of Microsoft's business. But they gave us a really decent quarter last week, but lackluster guidance. And this is important, not only because Salesforce.com is a software bellwether stock, but they're supposed to by now have real revenue acceleration from AI. And this is one of the things I've told you about AI. I like AI as a theme and where you can invest in the semiconductor companies like NVIDIA and AMD, and maybe the hardware companies like Supermicro, SMCI. But these enterprise AI software apps were supposed to be a thing. They were supposed to be a nice driver. And maybe that's TBD, but so far, no, because Salesforce was crowing about it. And they just gave their guidance for the full fiscal year. They're going to grow their revenues 8 or 9%, which is kind of like, who cares for a tech company? So again, I am worried about the take-up of these AI software apps. I'm not actually sure it's going to be as big a tech driver as some people think. Next, we did have some information released from the major PC companies last week, Hewlett Packard and Dell. And here is why you got to go with management. Because here are two companies that do the same thing. They're both trying to say that PCs will now be boosted by the AI trend, to be determined. But Hewlett Packard blew their quarter and Dell crushed it to the upside. So at the end of the day, when you are investing in these commodity business, right, mature businesses, saturated markets here and abroad, you better have the best management team because they're going to be scrambling to suck every penny of profits. It looks like Dell's great. Looks like Hewlett Packard is not. So if you get lulled into this space, go with Dell. No Hewlett Packard. Next, there are a couple of stocks that I call dead cat bounces. I love to give you my cool Wall Street phrases. Remember a couple of weeks I told you about the cockroach theory, where if a company has a positive quarterly surprise where they beat analyst expectations, or unfortunately a negative one where they blow it, typically they have more positive earnings surprises or more negative earnings surprises. That's the cockroach theory. I believe in it because I think they come in scores. But also the dead cat bounce. Sometimes you have really crappy companies that do a little bit better than the worst case scenario that Wall Street was expecting. And they have these humongous bounces. So when you think about a dead cat, I'm holding a dead cat. I drop it to the ground. It's not going to bounce like a Super Bowl, right? So anyway, Okta, Duolingo, a couple of other companies that have given up the ghost over the last year or so have slightly better than really awful quarters, and they have a dead cat bounce. I tell you, do not buy the dead cat bounce. You want to sell into that or maybe even short those stocks. Next, we did get some reports from some of the AI companies, right? And I'm a little bit concerned. I was not impressed at all with Salesforce.com, but we have another company that is well known in the space, or at least trying to be, a company called C3 AI. They were smart because they use as their stock ticker symbol AI, and all they have to do is that, and the stock goes up. Just like all you had to say is .com in 1999, your stock went up. But I will tell you, I've been taking a look at the results of C3 AI and Big Bear AI and Soundhound that I'll get to in a minute. And you guys, they might have had some decent bounces after these quarters, but I'm not convinced. These are very small, emerging companies. I don't know if their AI apps are going to be drivers at all. Stay away. Stay away. If you want to invest in AI for the time being, continue AI infrastructure, semiconductors, and hardware with my favorite pick, Supermicro. So next, let's talk about some of the favorites in my portfolio. You shouldn't expect a lot of movement here, but I do have a new one this week, and then kind of a warning about one of my stocks, which has me move it from a buy to a hold. But I continue to like in cybersecurity, CrowdStrike much more than Wall Street's more popular Palo Alto Networks. I think Micron is going to have a very nice surprise to their quarter when they announce their results on March 20th. And they're going to guide to another nice, probably pretty lengthy upcycle in their sale of their memory chips. In telecom, I continue to like T-Mobile. Google/Alphabet, for the reason I described earlier, this latest PR miscue with their AI Gemini launch. I think the stock is probably a hold, but not a buy. As I said before, the stock is trading at 138. If it drops down to 132, its 200-day moving average, and holds that, then I'm a better buyer. Right now, I'm a little queasy, but not queasy enough with Google that I'd out and out sell it. Microsoft on the list, Meta on the list, Amazon on the list, the electronic design automation software company, Synopsys on the list. Yes, still like NVIDIA. Yes, Still like super micro as my infrastructure plays for AI. And remember, you heard it here first. 2 weeks ago, right in the middle of the show, SMCI was down 20% as I was speaking. I stopped the show, said, this is ridiculous. I said, buy it. Hopefully you did. The next Friday, actually by the next Thursday, the stock had already rebounded 25%. And then I have Nice here, which is a call center software company that I like very much. And that was my fresh buy last week. And then I'm adding another one this week. This is a fresh money buy, ticker symbol IAC, IAC Interactive. This is Barry Diller's media company. You know, Barry Diller is a old school media tycoon. And what he has done over time is he's collected in a portfolio a number of internet properties supplemented by a couple of old school properties, trying to just suck the cash out of those. Like, for example, on the internet side of the house, IAC has Angie, which is the old Angie's List. On the old school media side, they have People Magazine. But if you take a look at all the pieces, and some of these pieces are publicly traded, so you don't have to go very far to value them, you collect them, and IAC itself is selling much less than just the sum of the parts here. I think it's a great buy. Now, where did I get this idea? I always give credit where credit's due. I always follow the best in the tech space, and there is a journalist by the name of Eric Savitz, and I've been speaking with him about tech ideas for 30 years, and he is over at Barron's. Had a nice entree to IAC and the investment idea therein in last weekend's Barron's magazine. Hey, man, you know what? You got to find the best and then be happy to move along with them. So that is my fresh money buy list. Got a little more cautious on Google. Added Nice last week. Added IAC this week. And now let's get to some tech trends. This is pretty cool because I've told you before, even though we love to talk about AI as tech analysts and portfolio managers, it's the 80-20 rule. That's only 20% of what's driving tech. 80%, much bigger piece is interest rates. Tech and other aggressive growth stocks crave lower interest rates. And if you believe, or if you don't believe, that the Federal Reserve Board, our central bank, is going to pivot to lower rates sometime this year, then these stocks, unfortunately, will take a spill. And what happens is the next Fed meeting, they meet about every 6 weeks, is March 19th and 20th. The afternoon of March 20th, they'll tell you what they are going to do with rates, and they'll also give you their forecast. And what's happened, which is actually my greatest worry in all of tech, is that we may not start to lower rates soon enough this year. And when we lower them, we may not lower them as much as people were expecting. And that is the biggest worry for tech investors. It has nothing to do or little to do with the success or failure of AI. One inflation gauge came out this week that was pretty important. It was the PCE, which stands for the Personal Consumption Expenditures Index. And that is the inflation gauge that the Fed watches, and they make their decisions based upon that trend. And it came out for January, the PCE core, which peels back food and energy because they're too volatile. That figure was up 2.8% year to year and 0.4% month to month. And it was spot on with what Wall Street was expecting. So I still think a pivot to lower interest rates is in the cards in 24, but it might be the second half of the year rather than in the next couple of months, which was originally the view. So the next is, and this is kind of interesting, Mobile World Congress. It's a big to-do for the smartphone manufacturers in Barcelona, Spain. And one of the things that they're all touting, right? Because you think about it, the smartphone market and the PC market are both very mature slow growing markets, saturated businesses in the US and abroad. And so if you're going to believe in the smartphone market, and remember 60% of Apple's revenues are its iPhone franchise. And we saw the PC results, as I mentioned, from the likes of Hewlett Packard and Dell. But if you think that this business is ever going to have a growth spurt again, you got to believe that we're going to have AI chips on board on our smartphones and our PCs. AI, not in the cloud that you access through your smartphone or PC, but actually on board. Now, of course, everybody in Barcelona was saying, we got that. Remains to be seen. We'll see if we do get AI on board on the hardware, smartphones and PCs. And if we do, does anybody give a shit? We'll see what happens. The next thing I thought was interesting is obviously President Biden wants to be reelected on November 5th. And so he is pushing to hand out all the money that the Congress approved in the CHIPS Act about a year ago. Remember at that time, we're trying to reshore semiconductor manufacture to the United States. And Congress did pass over $50 billion to do so. And so just this past week, a $5 billion investment in something called the National Semiconductor Technology Center. First of all, $5 billion is a pretty big chunk. Second of all, the problem is, do you want the government innovating? And so I don't know if this is money well spent. I don't want the bureaucrats innovating, because product cycles in technology sometimes can be short as 18 months, and then you got to move on. I don't know, $5 billion, letting those guys run it. I think I'd back off on that. The other thing that Biden did this week is he did sign an executive order to protect users' data on social media. Obviously, we don't want all that stuff getting to the Chinese or maybe to the Russians. Again, I thought, okay, political posturing, does it really mean anything? Is it really anything new? I think not. The next, and I think this is a really important trend in technology. We've had a number of tech companies that have recently announced bundling of their software products. And this is a negative tell for software, because here's the deal. When you think that your point products are no longer growing, what you do is you bundle them all into a suite, and then you require your customers to buy the entire suite of products, even if they don't need that extra functionality. And of course, you jack up the price. We've seen in software a number of companies employ this tactic. This isn't good news. This is bad news, because they're desperate for growth. The next trend, which is super important, is this battle that will go all the way to the US Supreme Court over First Amendment use of social media. So I don't know if you know this, but we are still following legislation in this country that was passed in 1996, right when the internet was becoming more mainstream. And it's called Section 230. And what we're trying to wrestle with here is, say, a social media property like a Meta. Should it just be a data pipe? Somebody creates the content, they're the pipe, and they push it through without any touch. Or are they like a newspaper or magazine publisher that has a responsibility to curate the news before they send it along? It is the ultimate conundrum. And it is really this decision going to change the way some of these business models interact. And we'll see what happens, because it's going all the way to the highest court in the land. The next, last week, I badmouthed a company called Soundhound. Specifically, it's Soundhound AI. There you see it up on the screen. Ticker symbol SOUN. And this was triggered by a viewer of this segment that reached out to me. That stock was soaring because they announced a very small investment by NVIDIA. And of course, investment is the God who walks the earth. Anything that they touch turns to gold. But here's the deal. They overplayed their hand. And NVIDIA, at the end of the day, bought a stake in the company. Actually, they bought it as far back as 2017, and they didn't even buy a 0.5% ownership in this company, and it's a small company. And so what happens is I badmouth it on air, tell you to sell into the strength. Today, the stock is down 15, 20%. So I was right, because last night they reported a quarter and it sucked. And so based on their fundamentals, the stock is reversed. So anyway, be very careful about some of these AI plays, because I just don't know if they have legs. And I think Soundhound's a pretty crappy company. Next, the other thing you should know is Soundhound had a big pop because the stock was heavily shorted. And with a heavily shorted company, in which you're making a bet that the stock goes down, if there's any sniff of good news, the way short sellers cover their short positions so they don't lose more money is they have to buy the stock in the open market. So Soundhound had a big short position. They had to be forced to buy the stock. It drove the stock artificially up. And also, Soundhound had a very small float. So it's a very small company, but 12% of its float, which is actually the stock that actually trades, that's not held by insiders, that was sold short. And so when you see a company that is sold short, we got a big short squeeze that can lift the stock, and it's going to be exacerbated when you have a company that has such a small float of shares outstanding. So I saw that and told you to sell into the strength. And now we've made another really, really good weekly call. The other one is a company that I've said the same thing about. It's the semiconductor company ARM. Actually, it's a licensor. They don't make the chips itself. But they had another huge pop on their quarterly result about a week ago, which I say short that stock now, because it had a decent quarter. It wasn't great. This isn't a fast growth company. However, 90% of the stock is held by insiders, SoftBank, a company out of Japan, and only 10% of the shares outstanding float. And so it had a oversized positive impact because of the small float, because it was heavily shorted going into the quarterly print. Again, when that happens, it ain't nothing to do with fundamentals. It's actually a chance to short the stock again, or at least sell into the strength. The last thing I want to hit on today, which is kind of interesting, Microsoft announced a pretty interesting AI partnership last week with a French company called Mistral. And I just want you to know that, I don't know, does Mistral become the next NVIDIA? Maybe, maybe not. But I will tell you this. Occasionally, we find stories abroad. Sometimes they're more mature companies. Sometimes they're emerging companies that sometimes tech investors in the States don't give them a fair shot because they think that it's an unpatriotic thing to do to leave our shores with their investments. Yes, Silicon Valley dominates the world's tech landscape. But I will tell you this, do not be a homer, because there are a couple companies that totally dominate the world that are tech companies that are abroad. The best known is Taiwan Semiconductor. They make the most advanced chips for the most advanced designs, and they have about an 80 to 90% market share. Of course, they're in Taiwan. They're not in the United States. NVIDIA does not exist without Taiwan Semiconductor, because Taiwan Semiconductor is its outsourcer. Then there's a company in the Netherlands called ASML. ASML has the key technology in manufacturing semiconductors. This would be a company that we call a semiconductor capital equipment company. Has technology called EUV, extreme ultraviolet. In the future, if we're going to continue to build chips smaller and smaller and pack more transistors on them, you require EUV technology, and there's only one place in the world you get it, from the Netherlands with ASM lithography. So I tell you guys, it's okay. I'm patriotic. I teach at a military college here in Charleston, South Carolina, the Citadel, but don't be a homer. There are plays beyond the United States. And so, you guys, that's all I have for the week. I know it was a fire hose of information, but I'm Paul Meeks. Our director is Aaron Thomas. I'm supported by my good friends here at Benzinga, and we will see you next week. Keep coming back.